The stock market is crashing! The stock market is crashing! What do we do? Stick around. I'll explain how the stock market works so you can understand what this current correction means to you and your investments. Hi, I'm Chloe Bear Money Coach. Welcome to my channel. If you're new here, this is where we talk about all things money. Now, in the last month, you may have been paying attention to the stock market and thinking, holy crap, what am I doing? This is a crash. I should pull out all of my investments. In this video, I'm going to explain what the correction means and how this should inform your investing decisions moving forward. Now, before we get started though, there's two things I want to make sure are very clear. Number one, be sure to hit the like and subscribe button. It helps my channel out a lot. And number two, this is not financial advice. This is for educational purposes only. I am not a financial advisor or a CFP, so ultimately at the end of the day, all I can do is give you my opinion and give you some education so that you can go off, do your own research, and make informed decisions. So if you got those two things done, you've hit the like button, you've hit the subscribe button, and you understand the fact that this is education only, let's get to it. So if you've been paying attention to the stock market at all, you will have seen that year to date, as of filming this on February 4th, 2022, the S&P 500 is down about 6.5%. And if you're paying attention to the stocks inside of the S&P 500, you'll notice some of the stocks are down even all the way up to 50%. Now, what does this mean? What we're experiencing now is called a stock market correction. Oh, we gotta take a break for Logan. Logan wants to tell you that a stock market correction, all that is it means that, Logan, your tail is hitting the podium. Yeah, it is. It's probably making this shake right now. So I appreciate you, but you know, we gotta talk about stock market correction. So a stock market correction, what that means is that the stock market, whatever stock you're following, whatever index you're following, whatever market you're following, is down by about 10% from its most recent peak. Now, the S&P 500 specifically had some of its all-time highs last year in 2021. The S&P 500 had all-time highs last year, so it's pretty normal for us to see something called a correction. So the S&P 500, which contains a lot of tech stocks, was probably considered overflated back in 2021. A lot of people were driving money into it, and that caused a lot of finance experts to be concerned that we're overvaluing the stocks that are inside of the S&P 500. So it's really no surprise that we're experiencing what is known as a correction right now. Think about it this way. We were too high before, so we've got to correct in order to get back to the balance that we are expecting to see moving forward. What I want to emphasize in this video is that this is a normal part of investing. So it's not smart to panic and sell all of your investments right now. In fact, that's probably the opposite of what you want to do. Instead, you need to educate yourself on what the stock market does as a whole and what it's been doing for the last 100 years. So let's talk about it. So what you see right here is a chart of the stock market over the last 100 years. This particular chart shows the performance of the Dow Jones for the last 100 years. What you'll notice is there's a lot of ups and downs as we go through the last 100 years, but generally we're on an upward trend, especially when you're paying attention to the last 40 years. Since 1982, we've had a huge rise in the stock market, and it just continues to climb. Now, what does this mean to you? The ups and downs are things that are really, really difficult to time. Timing the stock market is incredibly difficult to do. The reason is because lots of different things impact what the stock market is doing on any given date. It could be wars, it could be,
worldwide illnesses, it could be investor emotions, it could be economic changes, it could be business decisions.
There are so many things that influence how the stock market is doing on any given date. So really, it's incredibly difficult for us to plan what's going to happen. Even the best minds of the world in the finance industry try to predict what's going to happen with the stock market, and they fail over and over again. Looking at you, Robert Kiyosaki. So it's really incredibly difficult to try and time the market. So let's go over some of the studies that have shown just how difficult it is to try and time the market. Now, before we look at some of those studies, let's get one thing clear. What is trying to time the market? What does that even mean? Trying to time the market means that you are trying to buy low and sell high. Sounds great, doesn't it? Like that's generally what you think of when you think about investing, right? But the reason that that's actually not the most effective approach for most investors is because trying to time the market is incredibly difficult. So let's look at some data. So let's start with the SEC. The SEC is a Securities and Exchange Commission, and they did a study that found that most active traders, which are people who are buying and selling on a daily basis, trying to make as much money as possible by trying to time the market, 70% of traders lose money. And you look at the performance of their investing over the course of a year. This study also showed that traders typically lose 100% of their money within 12 months. Keep in mind, the stock market, just like the economy, goes through cycles. So there are periods when stocks are going to be high, and then there are periods when stocks are going to be low. That is completely normal. So according to the Motley Fool, a stock market correction, which remember, that's taking from the highest peak and going down about 10%, that happens almost once every 2 years. Now, a bear market, which was when stock prices are going down for a significant period of time, usually happens once every 8 years on average. Now, the average correction can usually last between 6 and 9 months, but it could be as short as a few weeks or as long as 9 months to a year. But now when we look at bull markets are when stock prices are going up. The average bull market lasts usually for years. They're often measured in years rather than in months. Again, this is totally normal. Now, another reason that it's not a good idea to try and wait to time the market is because a lot of times when people are waiting to try and time the market and buy at its lowest potential point, you're spending time not invested in the stock market. And honestly, staying not invested in the stock market, in my opinion, is one of the riskiest things you can do. JP Morgan actually did a study from 1999 all the way up to 2018, which is on almost 20-year time frame, and they showed that even if you miss the 10 best days in the stock market, your overall returns were cut in half. Which is wild. You only had to miss 10 days over the course of 20 years. 10 days, it's so hard to figure out when stock markets are going to reach their highest, but if you're missing out on their highest points, the highest points throughout that time frame, you are going to see significantly fewer returns from your investments. Now, another study by Putnam Investments showed that if you were invested fully in the S&P 500 from 2003 to 2018, if you missed out on, again, the 10 best days in the market, your returns were cut down to 2.65%. Now, this was another study done by Putnam's investment firm. Now, I love this type of data when it comes to learning about the stock market. It really helps ease my mind when I'm looking at my investments. So let's share a couple more, shall we? So another investment firm called Dalbar Firm did a study to show what an average active trader, what their performance was versus the S&P 500 during the same time frame. What they found that during that 20-year time frame that they were studying, the average investor, i.e. somebody who is actively trading, their returns were 5.29% over that 20-year period. The S&P 500, it returned on average about 7.2% a year. Now, there was another infamous study that was done by Warren Buffett. Warren Buffett actually bet a hedge fund company that they could not beat the S&P 500. So he gave them a 10-year time frame and basically said that if you're able to beat the returns of the S&P 500, I'll give you $1 million. If you don't, you have to give me $1 million, obviously. So what happened after those 10 years of investing? The hedge fund managers, their average annual returns over that course of the 10 years was 2.2%. The average annual returns of the S&P 500 were 7.1%. So what does all of this mean? With all of this data, with all of these studies, and these are just a couple of the studies, what does that all mean? Personally, I take it to mean that trying to beat the market, trying to time the market is incredibly difficult to do. And if the best minds in the finance world can't do it, the likelihood of an average Joe investor like me being able to do it is pretty slim. Personally, I would rather be investing in the whole stock market. Because time and time again, when we're investing in broad-based index funds, they're going to outperform most active traders as well as most actively managed mutual funds. So how do we get around this whole trying to pick stocks? What is the thing that we do instead of trying to time the market? Instead of trying to time the market, we buy very diversified investments, we hold for the long term, and we stick to the plan plan despite whatever is happening in the stock market. Another key component of this, of being a successful lazy investor, is making sure that you have a long-term time horizon. Trying to actively trade, trying to buy and sell in the short term is a really surefire way to potentially lose money. So if you're investing for the long term, actually the chances of you losing money gets reduced the longer you hold the investment for. So let's first define what is long-term investing. Long-term investing is generally when you plan to buy and hold an investment for the long term. And when we're talking about long term, we're talking about 10 years or more. Really, even you could say 5 years or more, but when you get to 5 years, you're kind of getting into that gray area of being kind of a short-term investor. But generally, if we have a decade or more to invest, we don't really need to worry that much about the stock market crashes because we have plenty of time to make up for those stock market crashes. But let me give you some more data, right? So BlackRock investment firm did some studies to really determine how often do you lose money if you're invested for a year, 2 years, 3 years, 5 years, all the way up to 15 years. This study that they did from the course of 1926 all the way to 2019, which is almost 100 years, if you were only invested in the stock market for a month, this study showed that you had about a 62% chance of making money during that time, and you had about a 38% chance of losing money in the stock market during this time. Now, if we fast forward out to 5 years, those odds get a little bit better. So when you're looking at a 5-year and holding the S&P 500, holding your investments, you have an 89% chance of making money in the stock market and an 11% chance of losing money in the stock market. And when we get all the way out to 15 years or longer, we're holding on to our investments for 15 years or more, you have a 99% chance of not losing money in the stock market and actually making money in the stock market, and you have a less than 1% chance of losing money in the stock market. So again, if you're buying diversified investments and you have a time horizon of more than 10 years, the chances of you actually losing money in the stock market are pretty slim. Now, this only applies if you are diversified. If you are YOLOing on just Apple stock or AMC stock or GameStop stock, that's a lot riskier. When we're talking about long-term and successful investing, we're talking about holding very diversified products. So total stock market index funds, S&P 500 index funds, those have hundreds if not thousands of stocks inside of them. So I hope with all of those different studies, all the different information that I was able to provide, it kind of gives you a little bit of perspective on really what it means to be a long-term investor, a diversified investor, and somebody who is really making sure that their investment portfolio is crafted in a way that is according to their risk preference. Now, you may have a wild risk preference. Maybe you live at home in your parents' basement, so you prefer day trading stocks and options trading and Forex and things like that. Well, then I'm probably not the right channel for you. But if you're somebody who is interested in lazy investing, where you're able to purchase the whole market and just kind of chill and not worry about what the stock market is doing every day, you better be hitting like and you better be hitting subscribe, because this is the channel where I am going to explain to you exactly how to do that. So thank you so much for watching today. I hope you found this helpful. If you made it through and you have questions or you thought that this was helpful, hit me up in the comments below, and I'll see you guys next week. Bye.